I mean, they're ramping 2 new factories. No, I don't think that's any explanation. That's not how the accounting works. Well, there's no reason to buy a Tesla car. I think that Tesla has big problems now. Tesla is not the leader anymore, and cars sold in EU / China, they're not the leader in any technological standpoint. This is the year that Tesla gets undressed, in our view.
Roses are red, violets are blue, Gordon's a clown. What else is new? In this video, we're hearing the latest arguments against Tesla and its current valuation from Gordon, the class clown Johnson, Mr. Humiliation Fetish himself, the intellectual punching bag, the laughing stock of Wall Street, which is really saying something, founder and CEO of GLJ, not a sham shop research. Did I say that out loud? No. So, let's get into it. Hey guys, thanks for watching. If you enjoy these videos, there's a bunch of ways you can support the channel, access exclusive content and perks, and get some free stocks and crypto. Check out the links in the pinned comment below. You can get 2 free stocks with WeBull, a free stock with Stake, free Bitcoin with Coinbase, and free Bitcoin with BlockFi, and the BlockFi Bitcoin Rewards credit card. You can also pick up some Tesla, Elon, and investment themed merch in the merch store. If you want to take it to the next level, join thousands of members on Patreon to gain exclusive access to over 100 Q&A videos, loads of exclusive content, exclusive access to my up-to-date 10-year Tesla stock price targets, and even access my Tesla valuation model at the investor support level and above. So check out the links in the pinned comment below, and thanks for your support.
Gordon Johnson is standing by here with us, the CEO and founder at GLJ Research, and it's time to talk some Tesla, of course. Gordon, what kind of bizarro world, welcome back by the way, Mr. Johnson, what kind of bizarro world are we living in where you, the biggest bear on the street, had like one of the most bullish revenue estimates for Tesla, and they nailed it? I know you talked with us a little bit about this last time. You said they're going to do at least, what, 17 and a half, and they did it.
Now, I want to address this. I know there's a large segment of the audience watching this channel who genuinely believe Gordon Johnson is an actual fucking moron. This is not true. Gordon is a very smart human. However, he certainly says things about Tesla that are asinine, extremely stupid, incredibly foolish, super dumb. But Gordon himself is no moron. The question we have to ask ourselves is, why is such a competent analyst so insanely negative on this company? For those unaware, Gordon has been covering Tesla stock for approximately a decade and has been a bear from day one. Some may argue Gordon's simply inflating his own estimates so that Tesla will miss on his books based on where he expected them to be at. Maybe a way of stirring up more bearish commentary, and they just keep beating even his own insane expectations. But honestly, I think Gordon is just doing the best job that he can and actually knows how to run the numbers, which is kind of a little bit of a troubling thing to consider, given the fact that he's more accurate quarter after quarter than the Wall Street consensus estimates from the people who should, in theory, be rational, reasonable, unbiased, intelligent, and capable of getting the numbers pretty close. When you've got an example, somebody like Gordon, who has a negative narrative, always something's going wrong with Tesla, the world's ending, the competition's coming, demand is collapsing in Timbuktu, on and on and on and on. But even this strange Tesla parma-bear is getting the numbers better than the people who don't have this insane perspective on the company. That really is something to ponder.
Yeah, so if you look at what Tesla sold incrementally in cars, it was about 65,000 more vehicles sold Q3 to Q4. You assume a $52,000 average ASP per car. That means the revenue number, at the very least, the consensus estimate should have been 17.4 billion. The consensus estimate was 16.6 billion. We believe our sell-side peers intentionally sandbag numbers to justify silly price targets. So when Tesla beats, they can put out their notes and say Tesla beat, and everybody else can say it beat. We had a number of 17.6. They did 17.7. However, we had a non-GAAP EPS number of 270. They did about 250, so they missed on that number. Here's what's key. They sold 19, their deliveries were up 19% sequentially. 19% sequentially, yet their gross margins were essentially flat.
At this point in time, while Gordon is painting a ridiculous, absurd, and fictional negative narrative about Tesla, I just want everybody to pay attention to the numbers on screen. We're looking at Q4 2020 to Q4 2021. In other words, what's happened over the past 12 months for Tesla as a business. We can see up the top, revenue growth has gone from 45.5%, which is a stunning rate of growth, to 71.4% year over year. This is insane. We're talking about an increase in multiple billions of dollars. It's absolutely nutty. Gross margin has gone from under 20% to close to 30%. Tesla's operating margin from a piddly 5.4% to almost 15%. An operating margin unheard of in the automotive industry. We've also got a massive increase in free cash flow of around $1 billion, which is up about 50%.
So it looks like this 200 to 300 basis points quarter over quarter improvement in GDP, or gross profit this company is seeing, has ended. And more importantly, we believe that over 100% of Tesla's profit comes from their Chinese plant. They don't disclose these numbers. We think they should. We think their PwC should make them disclose this. But we believe that given handouts and goodies from the Chinese government, there effectively are no costs associated with that plant.
Well, extraordinary claims require extraordinary evidence. Unfortunately, not everyone on Earth realizes this. That's why there's so many people who believe incredibly dumb shit. But this is a big claim. In essence, Gordon here is suggesting that the Chinese Communist Party is paying Tesla so much cash, kickbacks, rewards, incentives, etc. There are essentially no operating costs associated with the Shanghai factory. It doesn't cost Tesla anything to operate that place. It's free. This is the claim that Gordon just made. Unless, of course, I'm too high to understand his meaning.
There effectively are no costs associated with that plant. The problem, however, is we think all their other plants are loss-making. So as there are two new plants in Berlin, in Germany, and Texas ramp up, we think their margins are going to come down. But taking a step back, go ahead. Sorry.
No, that's an interesting point. So you're saying that the more non-Chinese plants they build, the lower their margins will go.
Yes.
Huh. Okay.
Yeah.
What's the evidence that it's the only profitable plant?
Well, before they built the Chinese plant, they were reporting losses excluding credit sales.
Okay.
And with respect,
they also didn't have as much scale, right?
Well, no. We think it's think about this. Let me give you the evidence. So in the 2020 10K, right, we found out that.
Nice to see Gordon being called out on some of his brain-dead bullshit here. The idea that before Tesla opened their China plant, they were losing money on their vehicles. Host with a very valid point. Gordon, that's because they were at a smaller scale then, right? Higher scale, margins increase, economies of scale. You know that. Surely you're a smart guy. Gordon appears to be a deer caught in the headlights after that. Then a non-answer and then change the topic.
Okay.
With respect,
they also didn't have as much scale, right?
Well, no. We think it's think about this. Let me give you the evidence. So in the 2020 10K, right, we found out that the long-lived assets associated with their Chinese plant are roughly 5% of their total long-lived assets reported. We found out that the debt associated with the Chinese plant is roughly 5% of the total debt reported. Yet the revenue associated with that plant is roughly 21% of their revenue. So how can the debt and the long-lived assets be so low reported, but the revenue be so high?
How could the factory be so profitable yet have so little debt and costs associated with it? Quite simple. It would be possible if Tesla was a rather resourceful company. They can build things for less than a typical company, ramp them faster than a typical company, make products in those facilities more profitably than a typical company. I know this is a crazy tinfoil hat theory, but hey, it is possible that this might be the answer to Gordon's question. It's worth invoking Occam's razor here. What's the simplest explanation? That Tesla was extremely resourceful and capital efficient in building Shanghai, which has become an extremely profitable venture, or that the Chinese Communist Party is somehow under the table effectively paying for Tesla's entire operation in China, and that because of these special gifts from the Chinese Communist Party, that Tesla is effectively cooking the books in their earnings reports and deceiving and misleading investors.
We think the answer is the Chinese government gave them a bunch of handouts, a bunch of goodies. They back and
what kind of goodies?
Yeah, well, effectively, they back and loaded the cost. So the actual real costs associated with that Chinese plant, we believe, aren't being reflected in the current results. So we believe commingling those results makes the numbers look much better than they actually are.
So Tesla gets energy credits from the U.S. government too. So if they get something from the Chinese, I mean, is that just how it works? Do these governments want the EV maker and that badly to where they're willing to pay for it? I mean, is that just a reality that we have to accept? I mean, I don't know about the Chinese data. Just going with your logic here, though, I mean, is that something that actually will work against them, or is that just a testament to how much governments are willing to subsidize the business?
Yeah, that's a great question. So what's happening is the Chinese government provides subsidies for EV when you buy an EV car, and you have to basically show a number of EV cars sold as a car seller. The problem is China just cut their EV subsidy 30%. They cut that January 1st, 2022. And January 1st, 2023, they're cutting it by 100%. So they're completely getting rid of EV subsidies. And taking a step back, with respect to your question, Tesla, before the Chinese plant, the way they showed a profit was they were selling all these credits to other automakers. The problem Tesla faces, and keep in mind, when you sell a credit, that's 100% gross margin revenue. The problem they face now is everybody's making EVs, so they don't need to buy these credits from Tesla anymore. So this is also going to be a hit to their gross margin. And keep in mind, right?
Okay, let's look at the numbers. I know they're a little small. If you can't quite see, just close your eyes and imagine they're bigger. We can see here automotive revenues in Q4 2021 of $15.967 billion, or $15,964 million. And of that revenue, a whopping $314 million with an M, not B, million dollars in regulatory credits. Less than 2% of Tesla's current automotive revenues coming from the sale of regulatory credits. We know over time this will go away, but it's already an insignificant portion of Tesla's revenue. Yes, it makes up a higher proportion of profitability because it's almost pure profit, but even in that context, it's still a drop in the water, and Tesla is going through phenomenal growth. They're going to go from capacity of 1.2 million to 2 to 4 million plus vehicles per year in just the next few years.
When competition comes, Tesla loses. In China, their market shares dropped from 23% to 11%. In the EU, their market shares fell from 33% to 12.9% when competition came in. And so in the US, their market shares fallen from 86% in the first half of 2020 to 66% in the first half of 2021. The reason I say that is because despite that fact, they're trading at 100 times earnings versus the auto industry average of 7 times. So when you have a company that's no longer growing gross margins, despite the fact that they grew units 19%, I think people owning this stock at this level have to really begin to worry, because now you have GM coming in the U.S., you have Ford coming in the U.S. We think Tesla's going to lose big market share there. And when you look at their technology, they're on 400-volt technology versus the majority of their competitors on 800-volt, meaning their competitors are more efficient, charge quicker. They rank dead last in autonomous drive technology. You have to be blinder than Stevie Wonder not to see the YouTube videos of their autonomous technology literally going in other lanes, etc. And with respect to their batteries, they buy batteries from the Chinese. They have no advantage there. The paint comes off the cars in the car washes, and the panel gaps are big enough to watch movies through. Consumer Reports ranked them 27 out of 29 in quality. J.D. Power ranked them 30 out of 33. So there's no reason to buy a Tesla car anymore. When you think about the Hyundai Iconic 6, you think about the Mercedes-Benz EQS, even the Ford Mach-E. So I think that Tesla has big problems now, and this margin issue, I think, is going to weigh on those who own this stock.
Nothing really new here. The competition is coming. Ford and General Motors are a legitimate threat to Tesla. There is no reason to buy a Tesla. The company has big problems. Oh, and we can't forget Tesla's full self-driving. Their autonomous software ranked dead last on a website run by a couple of out-of-work clowns. Nailed it, Gordon.
But specifically on the margin side, just forgetting the price of the stock for a sec, when they hit that gross margin at 29.3%, Gordon, when does that start to go the other way? When does this start to show up? Does it show up when they hit some level of market share? Does it show up when we see credits dwindle from governments? I mean, kind of what is the timeline here, and what is the process we're looking at to see if this happens, then the margin case will start to show up? What are we looking for here to actually cue that? Because if you're right, then I mean, that's going to be explosive.
Yeah, so it's already started to show up. Their margins last quarter were up roughly 260 basis points quarter over quarter. This quarter, it's roughly 80 basis points.
Right, still going up, just at a slower pace, right?
Yeah, despite the fact they grew units 19%. So when you ramp a new factory in Berlin, you're not going to get the sweetheart deal that you got with the Chinese Communist Party. When you ramp a new factory in Texas, while they're going to give Tesla a lot, they're not going to give them the sweetheart deal they got with the CCP. So we think as those plants ramp, we think their margins are going to come down. And more importantly, right, the chip issue is being resolved. There's tons of new competition. BYD outsells them 2-1 in China.
Just want to make a correction to the comment around BYD. This is including internal combustion engine vehicles that also have a battery inside them. This is not a fair comparison. These are ICE cars with the battery plus electric vehicle sales. ICE vehicles are already extinct. The meteorite has impacted. The skies are darkening. It's game fucking over. So if you really want to have a fair comparison, we should just be looking at electric vehicles sold globally per company. That's it. Forget drilling down by region and market. Fuck all of that. How many electric vehicles are they selling on planet Earth? The end. And anything that isn't a pure electric vehicle, aka the future, is a complete and utter waste of time. And not only is it a waste of time and resources, but it's an impediment. If you really want to have a fair comparison when talking about automakers and their volume of vehicles being sold, here's how the rules work. You can only count electric vehicles, but for every one internal combustion engine vehicle they sell in the same year, you need to deduct one electric vehicle sale, because that ICE sale is actually slowing them down and dragging them back into the past. Legacy auto companies don't seem to be getting this, or if they do, they're at least not discussing it publicly. It's not yet apparent, but in the next 6, 12, 18, 24 months, we're going to see the value of internal combustion engine vehicles fall off a fucking cliff. Once EVs reach sticker price parity, comparable EV versus comparable ICE car for the same price, it's game over. We're almost there. It's much cheaper to own and maintain an electric vehicle than an ICE vehicle over time. So consumers who know how and are willing to use a calculator and do so will realize, oh man, if I spend $40,000 on this EV, it's actually going to be the same as if I spent $33,000 in 5 years' time because of all the money I save. I might buy the EV. It makes sense. A few years after that, they're much cheaper. People don't seem to be really grasping this. But at that point in time, producing vehicles that are inferior, more expensive, cost more to maintain, don't perform as well, fall apart, require more maintenance, pollute the environment, oh yeah, and are inherently less safe by design, they don't have a low center of gravity, blah, 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 blah. It's financial fucking suicide. So as EVs become the obvious choice, better and cheaper versus ICE vehicles, inferior and more expensive, this is the point where you don't want ICE vehicles to make up any of your business, and this is a problem for legacy automotive manufacturers. They will not be able to scale up their EV production anywhere near as fast as their ICE vehicle production needs to scale to zero. Here's what happens in the next few years. Legacy automotive manufacturers implode. Revenues, profits, everything implodes as they try to scale up EV production. At the same time, consumers stop showing any interest in their inferior ICE vehicles versus EVs. And at the same time, legacy automotive manufacturers are imploding. Many EV startups will also be imploding, and Tesla will be exploding. And when I mean exploding, I mean in a good way. Like, bad would be your girlfriend exploding at you. Good would be exploding on your girlfriend. You definitely imagined hearing me say that. And besides, you don't have a girlfriend.
VW outsells them 2-1 in the EU. Ford is coming for their neck in the US. So is GM. So that competition is going to force them, we believe, to get aggressive on prices. Listen, Tesla is not the leader anymore in cars sold in EU / China. They're still a leader in US. We think that they lose that this year. They're not the leader in any technological standpoint. They don't make their own batteries. BYD does. They rank last in autonomous driving. Consumer Reports and JD Power rank them nearly last in quality. And their cars, the paint's coming off. So the point is, I think that this is the year that a company trading at 100 times earnings versus the auto industry average 7 times, the growth story comes undone. And what people will say is, well, they're not a car company. Yes, they are. 95%.
Yeah, I'm with you on that. It's a car company.
Comes from selling cars. The other 5% from a profitless energy division. So I think that this is the year that Tesla gets undressed, in our view.
I actually agree completely with Gordon here. This is the year Tesla gets undressed and the Tesla bears proceed to bend over, and then Tesla, you know what, I don't want to get cancelled. Let's move on. Stick around. We're about to watch Gordon absolutely implode on air.
And people accuse us of hating Tesla. We don't hate Tesla. We think it's grossly overvalued. And we think that becomes clear this year.
Hey, Gordon, on the margin side, too, I mean, CapEx is almost doubled from a year ago. I mean, they are spending to build out these plants and the other research arms as well into the tech for the cars and the batteries and stuff like that too. I mean, can that explain away some of the margin growth slowdown that you're observing? How does that play in when, I mean, they're spending. I mean, they spent roughly $2 billion, for the quarter. I mean, that's quite a bit up from a year ago, like 75-80%.
Yeah, I mean, they're ramping 2 new factories. No, I don't think that's any explanation. That's not how the accounting works.
So it seems as if when Gordon's supposed logic in his logicless arguments is challenged, by the way, congratulations, shout out to the anchor for actually calling him out on this, Gordon's brain seems to completely break. Let's watch that again.
That's quite a bit up from a year ago, like 75-80%.
Yeah, I mean, they're ramping 2 new factories. No, I don't think that's any explanation. That's not how the accounting works. One thing that's important, though, I want to talk about free cash flow, right? This company points to free cash flow. Now, when Amazon reports free cash flow, they report free cash flow including the financing and their financing cash flow, because they use loans effectively to finance some of their building. So does Tesla, but they don't report that number. Point is, when the Shanghai plant ramped, their OpEx actually, when that plant came online, their OpEx went down. Their OpEx should have went up massively. Why? Because the Chinese government is providing them loans. So the real free cash flow number for this company isn't what it appears. And I think that's something that people should be aware of as well.
Okay. All right. The year that Tesla gets undressed, I'm going to hold you to it, Gordon.
All right, buddy.
Well, at least Gordon and I can agree on this one point. Tesla will definitely get undressed in 2022 and proceed to completely and utterly fill in the blank the legacy automotive manufacturers and the entire ICE industry. In either case, I'd love to know what Gordon is smoking. In fact, I might even try it. But as I said earlier in this video, don't underestimate the guy. He's much smarter than the impression you'd get from the things he says about Tesla. And don't forget, check the links in the pinned comment, join Patreon, support the channel, access a ton of exclusive content. There's also links below for free stocks and free crypto. See you guys in the next video. I'm Stephen Mark Ryan. This is Solving the Money Problem, and I love you all. Hey guys, thanks for watching. If you enjoy these videos, there's a bunch of ways you can support the channel, access exclusive content and perks, and get some free stocks and crypto. Check out the links in the pinned comment below. You can get 2 free stocks with WeBull, a free stock with Stake, free Bitcoin with Coinbase, and free Bitcoin with BlockFi, and the BlockFi Bitcoin Rewards credit card. You can also pick up some Tesla, Elon, and investment themed merch in the merch store. If you want to take it to the next level, join thousands of members on Patreon to gain exclusive access to over 100 Q&A videos, loads of exclusive content, exclusive access to my up-to-date 10-year Tesla stock price targets, and even access my Tesla valuation model at the investor support level and above. So check out the links in the pinned comment below, and thanks for your support. And if you're still watching, you're awesome. I read every single comment on this channel and I really appreciate your feedback. So if you've got any thoughts on today's video, questions, comments, or suggestions for a new video, let me know in the comments below. Check the cards on screen now to browse the merch store, join Patreon, or watch the next video.